Good morning, everybody, and welcome to the session of Munro Forensic Actuaries, the Uncertainty series. As the series imply, we have a number of webinars running both last week and this week. Tomorrow I'll be doing another session on deceased estate maintenance claim matters. Please be sure to contact our office if you want to get a recording of any of the other webinars or attend the webinars that will still be conducted this afternoon and tomorrow. My name is Willem Boshoff. I'm an actuary at Munro Forensic Actuaries. I've been involved with Munro Actuaries since 2013, and I specialize in deceased estate and divorce matters. I will be assisted today by Damien Will. Damien is one of our senior actuarial analysts, and Damien is also an expert in deceased estate and divorce calculation matters. If you have any questions during or after the presentation, you will see there is a question and answer section where you can address any issues. Damien will be available to answer questions. And if you think of any questions afterwards, you are welcome to contact us. We will also share the contact details at the end. Briefly, some housekeeping rules before we get into the content of the presentation. Everybody is muted to prevent any delays in buffering. And there will also be a quick survey at the end of the session. We will really appreciate it if you can complete the survey and give us feedback. Thank you. So getting right into the presentation, we will briefly cover today the maintenance calculation, how it works on our side. And then I think the elements that relate to uncertainty is where we look into the future. And that is with inflation, our investment return assumption, mortality, and then I will also discuss some other factors or calculations, being a simple factorization, and also the need for financial advice. Now there's, I presume, a lot of uncertainty when somebody goes through a divorce. This is the type of uncertainty Zaza Gabor highlighted. I hope to never have to deal with that. I certainly hope to never have to divorce a man, but it's certainly the field I think our clients have to deal with more, is people and the emotions and the complexities of a divorce. The kind of uncertainty that we deal with is more what the Oracle of Omaha, known as the world's greatest investor, Warren Buffett, is talking about. And I think we are at a very apt point in time at the moment where the world is grappling with this uncertainty that's coming from the COVID-19 pandemic. And then there's lots of knock-on or consequent uncertainties, and one of them is certainly the world stock markets. There's a saying that if America sneezes, the world catches a cold. It's certainly also become the case. If China sneezes, the world catches, let's say, a cold. But we are going through a time where there's much upheaval and much uncertainty. And I think what Mr. Buffett alludes to here in his quotation is very apt, that we cannot control or predict these events, but we can prepare for them. And part of our work as actuaries is to attempt to stabilize and give people insight and understanding in the future to make the best decisions for the long term. Getting into the maintenance calculation, we are normally instructed to do a capitalized value of future maintenance. And I guess there could be all sorts of reasons for that, but the two we see the most is simply if people want to divorce and they want to have a clean break, they don't want the admin to have to deal with issues later. So it's a once-off payment and it's a done deal. The other one is what we have been seeing more of lately, and I think it's a function of markets and equity markets having gone sideways and now down, is that people ask us to calculate the value of what they can afford. So if, say, a spouse has to pay maintenance and they have X amount in savings, to calculate what the maximum amount is that they can afford in terms of paying maintenance. Now, our types of calculations is really two main types. The one is where we get instructed on the detailed future expenses of the claimant. This is the type of instruction we prefer, and I'll get into some detail later. But you can see on the screen there is just an example from an actual calculation where we have a list of every future expense, a cost and frequency that's applying to the present, and then we determine the capital value for life or for a certain age as instructed for each item. The other one is what we call simple factorization, or it could be versions of a simple factorization. And that's simply to say that somebody asks you to calculate a general all-inclusive amount. And that's where we, in the example on the screen there's, for instance, maintenance, and it's an amount that's supposed to cover all expenses. And then there's also a specification for the inflation, which would mostly be price inflation, but it could also be a fixed percentage escalation. It's something we often see in divorce orders, that there's a 10% or 7.5% fixed escalation, or it could be that there's no future escalation or no inflation applicable. In terms of our calculation methodology, there's a lot of words there, but I'll go over it very briefly. We determine the capital value of either the future general maintenance amount for each item, and there's three factors involved, and all three of those factors represent a certain amount of uncertainty. That being the future inflation, the investment return, and the mortality. So what we need for each item is the frequency, whether it's a simple provision, a once-off amount up front, or whether or not it's an item that occurs infrequently, like say every 5 years, or sometimes, or mostly an annual payment or a monthly payment. We have to calculate, we normally get instructed on the actual cost at this point in time, and then we have to project the value of each future incidence of this cost. So say monthly rent of 10,000 Rand a month, we have to determine what it's going to cost each month in the future up to the claimant's deceased. Then also the probability that this cost will be incurred. The probability is generally relating simply to the claimant being alive. There's occasionally costs that has other probabilities attached to it. For the purpose of this presentation, we'll just assume that being alive is enough to have to incur the cost. And then we will also apply the likely investment return that one can achieve when you invest the proceeds from the divorce award. So the sum that we're doing is basically simply we project the item into the future. So this is the cost in the future. We times the probability that the cost will be incurred, and then we discount it back to the present at the investment return assumption. And that will give us the capital value of that month's payment or that year's payment. And then we sum up all the payments over the future lifetime, normally up to age 100, or sometimes other ages are specified. What's important is the concept of the net discount rate. We sometimes get comparisons where, for instance, somebody would say, well, we assume inflation in the future is 5%, and the investment return is 7.5%. And somebody else would say, well, inflation is going to be 10% and the investment return 12.5%. Although those assumptions seem very different, the fact is that they will actually give more or less the same answer, because the important issue is not so much in absolute terms what your inflation assumption or your investment return assumption is, but how they relate to each other. So we look at the difference between what is assumed to be future inflation and what is assumed to be future investment return. And the difference between those two is called the net discount rate. So getting straight into inflation. Most of us are familiar with the concept of inflation as the consumer price index, or more accurately, the percentage increase in the consumer price index is the applicable inflation over a period of time, and we would typically refer to it as price inflation. This inflation is a little bit problematic, especially for middle class and higher LSM individuals or households. I'm sure most of us has felt the pinch where inflation numbers come in at 4 or 5% per year, but your personal expenses simply seem to increase by more. The reason being that the inflation numbers are a very broad-based number. The government does or the Statistics Africa does the household expenditure survey, from which a representative sample of South African households' expenses are tracked. And just being the demographics of South Africa, this will be weighted towards lower income households. So your CPI number is really representative of the spending patterns of lower income households. There's obviously some middle and higher income households in there as well, but because they're a low percentage, the influence is muted. And the reality that we experience is what economist Mark Schuessler coined as suburban inflation. And suburban inflation is the difference, or is really what most of our claimants will experience in reality in terms of their overall expenditure. And the chart there is simply taken from economist.co.za. And it's just an example to show the second bar is a headline CPI or price inflation. And many of the items that a middle and higher income household will experience actually experience significantly higher inflation. So ideally, we would like to have inflation or separate inflation assumptions for every expense item. Unfortunately, that is not possible. It's simply not pragmatic. We don't have enough data to determine inflation for each item. But we do have enough data to deal with three major categories of expenses. The first one is simply price inflation or CPI. But then, because adequate data is available, we've made the assumption that earnings inflation and most expenses that has a strong link to earnings generally experience inflation in the order of CPI plus 1% per annum, and then medical inflation, which could be a significant part of the expenditure, being CPI plus 2% per annum. And that's also how we apply these rates. We basically use CPI or price inflation for all items, except the ones where we use earnings inflation or medical inflation. And especially earnings inflation is interesting. There's some very direct items like a domestic worker, where the pay is simply a wage, and that would experience or attract earnings inflation. But also certain items have a very strong component of expenditure or wages as part of the expenditures, which could include stuff like schooling. Especially private schools, we've seen that the school fees definitely outpace normal CPI inflation over time, and part of that is teachers' salaries. There's currently also a question as to whether or not municipal services should be included under that. We have not yet made that assumption, but we are certainly looking at that. And then medical costs are simply your doctors, your specialists, your specialist medication, hospitalization, and very importantly, medical aid. Medical aid is also referred to as medical insurance. What we've seen the last 20 years, especially with medical aid, is that the increases annually with medical aid has outstripped even the CPI plus 2% assumption. We do get that question saying, well, for instance, Discovery's premiums has gone up on average by CPI plus 4% the last 20 years. It's something that is simply not sustainable. And we remind clients that we make a long-term assumption, and that even though 20 years seem like a really long time, the reality is we make assumptions for the next 30 or 40 years. It's also worth noting that paramedical services, we will typically increase at earnings inflation. that would be the likes of physiotherapists or occupational therapists. The investment return assumption, our current assumption is based on what we call a stable portfolio of assets. And our current assumption is 7.59% per annum, which will give us a net discount rate on price inflation of 2.5% per annum. We do not change this assumption often, but occasionally we do review it often, and occasionally the review will give us data that is compelling enough to change it. The key here is that we make a long-term assumption, and therefore this assumption is not reactive to events like the current stock market crash. For now, we're definitely keeping our assumption stable, and as these events play out, at some point we may feel that this has caused a long-term shift in the return expectation, and only then will we adjust our assumption. It is important to note that this assumption applies to all the individuals who we do reports. We recognize that individuals have very different circumstances, different risk profiles, different amounts of assets, but unfortunately we cannot tailor a discount rate or an investment return assumption for each individual. It will be too large and too costly an exercise. So this broad brush assumption applies to everybody. The reason we use a stable portfolio of assets is we recognize that most claimants in divorce and other maintenance matters do not have other sources of income. Sometimes people do stay employed, but they do not necessarily earn a lot of money. I think by nature of the fact that you require maintenance tends to give us individuals who are not financially very well off. It's also normally a declining asset or base of assets that they have. So you get this pool of money from the claim, and immediately you start to spend that money without new monies coming in. And there's something that we call negative compounding that sometimes happen. And negative compounding simply says that if you have a declining pool of assets, then a negative return at any point of time actually hurts you a lot more than the scenario where somebody continues to put in new money into a portfolio. I will not go into the mathematics of that right now, but it is a fairly well-known concept in the investment world. We also find that generally our claimants are on the older side of the spectrum, typically people who are 50 years or older, and then there's also the need for sufficient liquidity. So all these characteristics of the investor require us to consider what is the appropriate portfolio for the individual. What the individual actually is going to do with their money is we don't know, and we don't have any control over it. But we look at the portfolio they should be investing in, and in our opinion, it is a stable portfolio. The stable portfolio here, referring to a portfolio in which there's almost or approximately equal shares of growth assets, that being equity and property, or income-bearing assets, that being money market and bonds. It's very important that our analysis for our assumption span the longest term data we can get our hands on. I think the longest term data that we have used is 89 years. And the reason for that is to give us a stable assumption. We cannot react to every market event, because often after a severe market event, there's a correction. It's only when there's a long-term change in the trend that we want to respond to that. As an example, I'll briefly go over an actual case of Mr. Botha, of course not his real surname, but he was a divorcee, already retired, and he had about 4 million rand in assets. He also got married again. And the case that was before us, or the calculation was, is that Mr. Botha's ex-wife insisted that he should be able to pay her a higher maintenance And what was revealed in the court case is that his entire pension, the maximum amount, was invested in an equity portfolio. And the reason he invested so aggressively was because he required the higher returns to be able to meet his personal expenditure and his ex-wife's maintenance. And the argument before the court was that surely, since he's invested in so much equity, that is the return assumption we should use, which was higher than our assumed return assumption. But we argued that we should not base our calculation on what he does, but on what he should be doing. It would be rational, and I say that with some respect for the circumstances, to take the course of action that he did. And most certainly, today it will be very clear why it was a bad decision to put most of his money in equity investments. So we believe it's the correct thing to do is to see what somebody should be doing, because people can, of course, do all sorts of things with their money. They can leave it under the pillow, they can go gambling with it, they can invest in cryptocurrencies. We simply cannot cater for all those possibilities. And therefore, it's appropriate that you look at what the rational or the reasonable investor will do. This chart briefly shows the returns taken from coronation unit trusts over the last approximately 15 years. The top black line shows the equity performance. The gray line is the money market portfolio. The red line is inflation. Importantly, all the assets are expected to outstrip inflation returns in the long run. But what is very clear is that your equity returns are volatile. They move up and down all the time, and your timing into and out of the market can also have a big effect on your return experienced. And therefore, we advise that your money market and your bond portfolios are used as a stabilizing influence, and your equity and your property is used to bring forth growth in the portfolio. Looking at that equity portfolio, we fitted a second order polynomial curve to the 15, 16 years of data to see what and that's not a proper long-term trend, but it's just for illustrative purposes. For the moment, we'll assume 16 years is long enough. And it shows that there's a fairly straight line fit. So what it tells us is that the average return over that period actually gives you a fairly good fit for the long-term expected return. Like I've alluded and said a few times now, what is very, very important is that we look at the long-term experience in a market. And I think, especially now, we can very clearly see how a sudden and severe movement in the market can change the perception. So if you look at this chart here, the two blue lines shows us what the investment return would have been if we looked at 5 years of data. Now, the solid blue line at the top says like literally a week before the market crashed. If we looked at 5 years worth of data, we would have said, well, the market gives us a slight positive return. Literally a week later, if we looked at the market again, our answer would have been that based on 5 years of data, the market gives us a big negative return. We don't know, neither of those answers are correct. The solid red line is probably the correct assumption, and that shows over the long run a decent positive return. But to show also the dotted red line, if we did the same analysis a day or two after the market crashed, it certainly would be lower than the preferred assumption, but the gap isn't as big, and that's important. So the longer term data we look at, the less impact market events have. If you look at the sort of the first third of that chart as well, it shows an event that was also unprecedented at the time. There was the 2007-2008 stock market crash on the back of the subprime mortgage crisis in the United States. And at the time, that was an enormous market crash. The market crashed by almost 50% at the time, but we see, in time, economies repair, markets repair, and that's why we look at long-term return assumptions. I'll go very briefly through mortality, and I think that's the unique actuarial value add in our calculation. We use the life tables from the 1984-1986 census, and we use life table 2. The reason we use the 1980 tables is because subsequent tables has been heavily influenced by HIV/AIDS. We know today that the effect of HIV/AIDS has been largely negated again. So there certainly is a case, and there's various parties at work to see how we can construct tables from more recent data. But for the moment, we believe the mortality experienced 84-86 is still appropriate. Table 2 was based on a racial construct, being white lives at the time. And today, we of course do not make those racial or do not differentiate on the basis of race anymore. But we feel that the lives representative or that was used in that constructing that table is representative of South Africa's larger population, and especially your middle and higher income population. And we also see a consistent increase in life expectancy, not only in South Africa, but in the developing world. So we believe an optimistic table is appropriate. There's something to note, and it's something we do encounter in practice, is the correct methodology of incorporating mortality is to look at each future month of life and look at the probability of being alive for that month, and then the probability of incurring the expense or the cost in question. What we sometimes see is that people simply ask for the life expectancy, and then they assume there's a 100% probability of incurring costs before that age of life expectancy. And then they assume you will die at life expectancy, and then there's a 0 probability of incurring the costs afterwards. That is not the worst calculation. It certainly is more accurate than not using mortality at all, but it is not the correct way of doing it. So we caution against people simply asking for life expectancy. The correct calculation is to look at each future year of life up to age 100, after which the probability becomes negligibly small, and to use that probability for each future year in our calculation. It's also worth noting that mortality does become a big factor in older people. From around age 40, 50, probability really starts to pick up, and not using mortality in your calculation will actually, at those ages, result in quite a big error. The chart here simply shows probability from birth, and what it also shows is for the first 18 or 20 years of life, there's actually a very high chance of surviving, very small chance of not surviving. So practically, we normally don't take mortality into account the first 18 years of life. And afterwards, it starts to pick up, really picking up speed from age 50. It's also, in this instance, looking at somebody from birth. The life expectancy at birth for a South African male is around 68 years based on life table 2. But then if we look at an individual of age 50, the life expectancy moves on. The reason being that you've already made it to age 50. So you're already part of a select group that's made it past that hurdle. And therefore your life expectancy is a bit higher. Again, we do not look at the blue line as our determinant in our calculation. We look at the red line, and it's also useful here to see how life expectancy or mortality increases dramatically after age 50. The simple factorization, it is an instruction we sometimes get, and it's typically along the lines of saying, just tell me what the cost is or the capitalized value is of 1,000 Rand of maintenance, or just 1,000 Rand for life. Now, the main thing to note here is we typically use price inflation in this calculation. And there's an example on the slide of what that will amount to. Now, the advantage of using this method, and we understand why we get instructed, is it's a fairly simple calculation, and there's a slight cost saving. And it does allow for lots of flexibility in its application. So it's used in negotiations where one can simply say, well, if it's 10,000 Rand maintenance and we simply times the amount capital value calculated by 10, or if it's 15,000 or 12,000, so it's easy to play with the numbers. There is, however, a very real danger in using this, and the main one is that you're almost certain to undercompensate your client, because a component of their expenses will attract earnings inflation and medical inflation, which are of course higher than price inflation. And simply using this one size fits all number based on price inflation is not appropriate. And there's also, in our opinion and experience, a very real risk of losing sight of certain expenses. If one uses a big number or a single number that's got to encapsulate all the expenses, and you do not have the discipline or go through the process of listing expenses, analyzing actual experience, there is the risk of missing certain items. And for that reason, we definitely prefer and recommend for our clients to rather instruct us on a full itemized expense list basis. But we're of course more than happy to do the factorization if that is the most appropriate in your circumstance. Going on to financial advice. Financial advice is of course not something we do, but we believe very strongly in financial advice, and we recommend that claimants who will be compensated via a lump sum make use of the services of a financial advisor. We think it's better to use an independent financial advisor, although that's not a necessity, but the financial advisor that is tied to an organization or a large bank do have incentives to sell that bank or whatever they tie to their products. And the independent financial advice just gives you the best chance to get the best advice. That said, it is important to note that our entire calculation is predicated on the claimant being able to earn the 7.59% per year, and that's after all fees and tax. Now, for most individuals, that would mean that you'll have to earn a return of more than 10% per annum in the long run before fees and tax. And that is not something that can be done by simply investing into a bank account or a simple low-risk money market account. You will have to have the knowledge and the skills to invest a portion of your assets in the stock market or other growth assets. And that's why we recommend using a financial advisor. We often find that claimants are people who were not the breadwinners, who are often not earning or are not financially empowered and don't really know what their options are in terms of investing, or also don't even know where to invest. A financial advisor's advice in this regard, and also to help you understand your risk profile, to help you assess and manage your expenses, can be invaluable. And on that basis, we really do recommend that your client appoint a financial advisor if they do not already have one that they trust and know is giving them a good service. We've also had cases where we had to determine the loss that people suffered because they were told by unscrupulous individuals or sometimes unscrupulous advisors to invest in high risk ventures and ended up losing a lot of money. So it's also important that your financial advisor is somebody that you can trust and has a strong track record. Now, on that note, we have a strong relationship with a financial advisor. He's a colleague and a good friend of mine, Eddie Tron. Eddie is at Convergency Wealth Management. And I'm going to give over to Eddie now just for a minute or two so that he can talk a bit about financial advice and what they do at Convergency Wealth.
Thank you, Willem, and good morning to everyone. I'm just making a few clicks here on my side to make sure that everything is set up. You should be able to see my screen now as well. Yes, thanks, Willem, for that introduction, and thank you for the insightful presentation. My name is Eddie Teron. I'm an actuary with about 20 years experience in the financial advice or the financial industry. And I work alongside Willem at Monroe Forensic Actuaries. And I'm really passionate about helping people and giving them professional, sound investment advice. To be able to do this, I've set up a 100% independent financial advice business called Convergency Wealth. And that independence is both in terms of full independence from Monroe Forensic Actuaries with the necessary processes built in to ensure client confidentiality, and also then independence in terms of the providers that I work with. Now, Willem alluded to the need for advice post-settlement in divorce matters. And I would like to just take 5 minutes to introduce you to the concept of a personal actuary coming alongside you as a divorce attorney and partnering with you to not only ensure that your client gets the best outcome possible, but also just to make your life easier. So the way I'm going to do that is just to talk through the process, how I understand it, that a divorce attorney and a client usually goes through, and then just to relook at that process and to see what would that process look like with the help of a personal actuary. So the process, as I understand it, would be that a client that is going through a divorce would contact you, the divorce attorney. And already there might be many interactions back and forth, realizing that an actuarial report is needed, and then a lot of back and forth in preparing for that actuarial report instruction to Monroe Forensic Actuaries, or to the actuary preparing the maintenance calculation. The attorney then instructs the maintenance actuary, and then again there's interactions between the attorney and the actuary to understand what needs to go into the report and to finalize it. And then after that, there might be some more interactions between the attorney and the client once that report, or in the process of producing that report. Then the attorney would receive the actual report back from the actuary, and then would need to explain that report and the implications of that report to its client. There could be more potential interactions then from the attorney back to the actuary based on what the client is saying. And after all those interactions, the client then receives the lump sum settlement. And the big question that Willem alluded to is, now what? How does the client then make sure that this money that has now been received is invested properly to ensure the desired lifestyle of the client? So what I would like to introduce to you is a value add that we've seen both from a Monroe Forensic Actuaries and a Convergency Wealth point of view, to better help attorneys and to better help clients through this process. So what this process could look like with the introduction of an independent personal actuary, which in this case would be me at Convergency Wealth. The process would start off in the same way, in that a client would contact an attorney. But from there on, the personal actuary becomes the first point of contact for the attorney. So the attorney would then contact the personal actuary, who then from there works in partnership with the attorney. And then the personal actuary takes all the legwork and does all the heavy lifting in terms of helping to prepare the attorney and the client for the actuarial instruction. Now, in our experience, we've often seen that the expenses that is sent through by a client and an attorney doesn't necessarily cover everything that the client might be spending money on. So already there's a lot of value in having a personal actuary sit with the client and making doubly sure that all the expenses are listed correctly. The personal actuary would then help the attorney to instruct the maintenance actuary, Willem in this case, and the personal actuary would then take over all the interactions between actuaries now, And again, the benefit there is having someone like myself who understands that process that the maintenance actuary is going through, that understands that process fully and that knows which inputs influence that process. The personal actuary would then also be able to explain the maintenance actuary's report to the attorney and to the client. And if there's any back and forth that is required between the attorney and the maintenance actuary, the personal actuary is able to take to help with that. And then, most importantly, in my opinion, once the settlement is then received, the personal actuary is then able to, because of the relationship he would have already now formed with the client, is then able to come alongside and help and coach that client to invest the settlement money in such a way to maintain the client's desired lifestyle. In my mind, that is one of the most important things to get right throughout this process. And as a attorney, I'm sure you would also take great peace of mind out of it, knowing that your client is in good hands and that his future is in good hands. If you would like to get in touch and to explore this concept of a personal actuary further, please do so on those contact details provided. And with that, I just want to thank you for your time, and I want to hand back over to Willem, and I'll let him conclude the presentation. Thank you very much.
Thank you very much, Eddie. We also, at the end of my presentation, lastly, there is some time for some questions and answers. We would love to hear from you, and as mentioned earlier, if you do not want to ask your question right now, feel free to contact us via email or telephonically to instruct us or to ask any questions. I've seen there was one question regarding how would one deal with uncertainty in divorce matters. To explain it in layman's terms, that is a difficult question. I can unfortunately not answer fully now. My short answer would be is to get an actuary and to get a financial planner involved. But we will ask that particular participant for their email address and be in contact with them to discuss the particulars of that question. I also want to see whether or not there are any other questions at this point in time. So if there's nothing popping up on the screen, I'm going to thank you for your time. Thank you for attending the session. Again, a reminder that we are hosting other sessions this afternoon and again tomorrow. And we certainly hope to see some of you there. Thank you very much and have a good day.